Please stay tuned for important disclosure information at the conclusion of this episode. Welcome to the Investing Insights podcast from Morningstar. In this week's podcast, Alex Bryan explores the growing landscape of ESG ETFs. Russ Kinnell prepares investors for what they can expect from mutual fund capital gains this year. Aaron Shapiro explains how election results can impact policy. And Aaron Lash shares opportunities for investors in the consumer defensive sector. Let's get started. Christine Benz from Morningstar Inc. and Alex Bryan from Morningstar Research Services explore ESG funds.
Hi, I'm Christine Benz from Morningstar. Funds with environmental, social, and governance mandates have been growing quickly, and ESG index funds have been growing particularly quickly. Joining me to discuss that group is Alex Bryan. He's Morningstar's Director of Passive Strategies Research for North America. Alex, thank you for being here.
Thank you for having me.
So, Alex, you and the team recently put together an extensive white paper on this topic of ESG index funds. You talked about the main subsets of ESG index funds. Let's talk about them, how you group these different products.
So there's three broad groups that we look at. The first is exclusions ESG funds. These are basically where sustainable investing started. These funds generally provide broad exposure to the market and then exclude firms that are in either controversial lines of business like alcohol, tobacco, firearms, fossil fuels, things like that, or that are involved in controversies like Wells Fargo was a few years back with their fraudulent account scandal, or Volkswagen with their emissions scandal. But otherwise, they provide broad exposure to the market. Broad ESG is the second group that we think about. These go one step further. So a lot of times these have this similar types of exclusions, but then they also have screens in place to tilt toward firms that have really strong environmental, social, and governance practices, what we call ESG. The focus of a lot of these funds is on how firms operate rather than on the products they produce. So, for example, a firm like Tesla, which makes a very environmentally friendly product, may not always score well on the ESG criteria these types of funds look at. And then the last group of sustainable funds that we look at is what we call thematic funds. These are funds that are more narrow, and they often focus on one issue related to sustainability. So it could be things like gender diversity, carbon footprint, alternative energy. And these funds are designed to be used more as satellite holdings.
Okay. So when you look across this universe, at the ESG group has been growing really quickly in terms of number of funds and in terms of assets. Where have you seen the most asset growth across these three different subgroups?
Broad ESG funds have really attracted the lion's share of assets, in particular broad ESG equity funds. So really investors are looking for core portfolio solutions to serve as substitutes for traditional index and active products. So that's where we've seen the bulk of the assets go. There are a fair bit of assets going into exclusionary funds as well, and a lot fewer going into the more niche thematic products. But broad ESG is where most of the action has been.
Okay. So there has been fairly substantial asset growth. Why do you think there hasn't been an even greater adoption of ESG products in the U.S.?
Well, the U.S. is behind other markets like Europe in terms of adoption. And I think part of that is due to this perception, at least historically, there's been a perception that by focusing on sustainability issues, you have to sacrifice performance in some way. Morningstar's quant research team actually did some work on this using Sustainalytics data and found that there really isn't much of a relationship, positive or negative, between sustainability and performance. And so I think that story is starting to change, where investors are realizing that there isn't necessarily a trade-off, so they can focus on the things that are important to them and still do okay on the performance front. So I think that story is starting to change, and that's helping to drive greater adoption, but still there's this perception that persists in certain corners of the market. There's a couple other issues at play as well. I think a lot of investors are concerned about alignment between the values that they care about and the portfolios that they're getting. Sometimes different ESG ratings between different providers can be very different for the same firm. So there, I think, is some concern that maybe I have an idea about the issues that I care about, but the portfolio that's being marketed to me as ESG may not necessarily align with the specific values that I care about. And so there's a lot of work that investors have to do to make sure that what they're investing in does in fact align. And then lastly, I think there's this debate out there about whether it's better to exclude ESG laggards, so the firms that are considered bad actors, so to speak, or if it's better to just own them in a broadly diversified index fund and then use things like proxy voting and engagement to prod those companies to change their ways. There's a debate on this issue, and I think that hasn't been resolved quite yet. But performance and perceptions around that, I think, have been the biggest obstacle to greater adoption. But that story is certainly starting to change.
Okay. So when you look across the universe of ESG index funds and ETFs to date, are there any funds or suites of funds that stand out as being really exceptional at this point?
So there's a couple low-cost funds that I like. So on the exclusionary front, if you want to keep it really simple and really broad, one fund to consider would be the Vanguard ESG US Stock ETF. This is a fund that basically provides broad exposure to US stocks of all sizes, but it does exclude firms that are engaged in certain lines of businesses like fossil fuels, firearms, tobacco, alcohol, as well as firms that are engaged in significant controversies. So it's just excluding a few of those controversial firms and then otherwise providing very broad exposure to the market, weighting its holdings based on market capitalization, and it's keeping fees low. So everything that we like about traditional index funds, we like about this fund. And if you do care about avoiding some of those potentially controversial companies, this would be a good option to consider. If you're looking to go a step further and really key in on those ESG leaders, the best of breed, a fund that we like there is iShares Edge MSCI USA Leaders ETF. This particular fund has similar types of exclusions to the Vanguard fund, but then it basically ranks companies within each sector on sustainability issues that could be material to financial performance long term. So, for example, in the financial services industry, it's looking at things like data security. How well are firms doing there? In consumer products, it's looking at things like packaging. How environmentally responsible are those companies being? So it's looking at issues that relate to sustainability that could be financially material, and essentially it's targeting the better ranking half of firms in each sector. So its sector weightings are very similar to the overall market. It does own some energy stocks, which may be a deal breaker for some, but otherwise it's looking for best of breed within each sector. It also is a very low cost fund, so it's one that we like.
Okay, Alex, really interesting topic. Thank you so much for being here to discuss it with us.
Thank you for having me.
Thanks for watching. I'm Christine Benz for Morningstar.
6 days a week, we deliver the latest news for investors. Just say, Alexa, enable the Morningstar skill, or visit morningstar.com/Alexa. Now, Russ Kinnell from Morningstar Research Services discusses what to expect from mutual fund capital gains this year.
Hi, I'm Christine Benz for Morningstar. Mutual funds typically make capital gains distributions in the fourth quarter of each year. Joining me to discuss what to expect in 2020 is Russ Kinnell. He's Morningstar's Director of Manager Research. Russ, thank you so much for being here.
Glad to join you.
So let's talk about the mechanics of this. Why do funds make these capital gains distributions typically in the fourth quarter of each year?
Mutual funds are required by law to distribute virtually all of the net realized capital gains as well as income over the course of a year that they've realized. And the process is that they sum up their capital gains realized through the end of October and then typically distribute those in the last week or two in December.
So funds typically make estimates to shareholders. When do we start seeing those typically?
Usually about a week or two into November, companies will post on their websites, they will post estimates of the capital gains payout for all their funds. And typically those estimates are very close to what actually happens. So they're pretty reliable.
Okay. So if I own a fund in an IRA or a 401k, this is kind of a non-event for me from a tax standpoint, right?
Exactly. This only matters for taxable accounts.
Okay. So if I own a fund in a taxable account and it is making a distribution, I will owe taxes on that distribution, correct?
That's right. Some people think at first, oh, well, they're paying me money. That's great. But no, actually, they're paying you money out of your own money and you're getting taxed on it when, from a tax standpoint, of course, you would rather have that compounding before paying the tax bill later on. So it's not a good thing, though. Obviously, if you've made really big returns, it's not the worst thing in the world.
Okay, so let's talk about 2020. It's kind of a funny year. We had a bear market earlier on. We still have a really big bifurcation in terms of performance, with large growth performing really well and small value in its own little bear market. So what should investors expect when it comes to capital gains distribution this year?
Yeah, I think this is a really unusual year, and I expect as a result, the capital gains story is going to be really all over the map because, as you noted, we had a bear market in February and March. So obviously, if you sold anywhere around there, or if your fund manager sold anywhere around there, they might realize some big losses. But since then, the markets rebound, and on the other hand, growth is up about 20%, value is down about 12%. So really depending from fund to fund, from stock to stock, there's going to be a really big difference. And so there's really a lot of potential outcomes for each individual investor, depending on what's in their portfolio.
So, do you have any thoughts about the categories or maybe specific funds where you might expect to see distributions? It seems like one thing that we know is when funds have had a lot of redemptions, that can sometimes trigger these distributions. Are there any areas that you're watching from that standpoint?
Well, a lot of the areas that have been redeemed, I think, are value areas which were hit hard enough that I wouldn't expect a big gain. But large growth has still been in outflows most of the last decade, and that's where the best gains are. So, where you have a fund there that's in outflows, I would certainly expect a significant payout, and really active management in general has been, for the most part, in steady outflows.
So, investors in a broad swath of actively managed funds could indeed see distributions. The question is, if a fund that I own in a taxable account has signaled that it's going to make a distribution, what are my options? What should I do in that instance?
Yeah, so obviously you want to prepare. So one thing, if you just bought it, you could possibly sell it just because you haven't realized a gain. But that's only rare cases, I think. Generally, you don't want to sell. If you've owned it for a few years, you would just be having a different kind of capital gains event if you sold. So that's no help. So one you can certainly prepare for it. The other thing, though, this year you may well have some losses you could realize to offset that. So obviously, you want to talk to your accountant about that. But if you have value stocks or value funds, you may hold something at a significant loss. And so one nice thing about this year with the gains and losses is there are greater opportunities to harvest losses than in a normal year. Like previous few years, for the most part, the market just kind of steadily gone up, and so there wasn't a lot in the red. But this year, we have a much more stark contrast between growth and value. So look at your fund and stock holdings and see if there's some tax losses you can harvest.
Okay, so you can do that netting of losses and gains. Let's talk about whether within taxable accounts, does it generally make sense for investors to avoid active funds altogether and stick with index funds or exchange traded funds?
Well, certainly, index funds and exchange traded funds have a big advantage because they rarely distribute gains. It's very easy for index funds and ETFs to manage those gains. So then, when you factor in taxes, it makes it an even higher hurdle for an active fund. So I would say, generally, passive funds and munis and others are probably the best way to go. I think if you want active, then certainly just be very choosy and say, okay, maybe these are areas I think they're going to do particularly well in, maybe an area that passive doesn't work so well in. Those are probably the best areas. But yeah, I think passive is probably the right default in a taxable account.
Okay, Russ, important topic, especially this time of year. Thank you so much for being with us to discuss it.
You're welcome.
Thanks for watching. I'm Christine Benz for Morningstar.
Watch all the Morningstar content you love from your living room. Download the Morningstar Roku channel and get up-to-date independent insights on today's markets. Be comfortable. Be informed.
Next, Susan Jabinski from Morningstar Inc. and Aaron Shapiro from Morningstar Research Services explain how the election can impact policy.
Hi, I'm Susan Jabinski with Morningstar. The election is less than a month away. Here with me today to discuss some of the key policy issues that the next administration will be likely to address is Aaron Shapiro. Aaron is Morningstar's Director of Policy Research. Aaron, thanks for joining me today.
Thanks so much for having me.
Now, you've said that the election will really determine the next move in this sort of ongoing battle over the regulating of financial advice. Before we get into that, let's step back a little bit and talk about where we are today. Regulation Best Interest did go into effect this year, right?
That's right. So Regulation Best Interest went into effect of June 30th of this year. And that regulation only applies to broker-dealers. The increased disclosures apply both to broker-dealers and registered investment advisors. And it does aim to at least somewhat mitigate conflicts of interest in sales, although it doesn't have bright line prescriptions for the most part around how to mitigate those conflicts of interest. Now, the other thing that's happening right now is the Department of Labor has reproposed a fiduciary rule that would apply both to broker-dealers and registered investment advisors, but only if they're giving ongoing advice. This is an ongoing relationship, so we'll see where that proposal goes.
So, given the variety of different election outcomes that we might see, what do you expect the next steps to be there?
So, in one possibility, Biden unseats Trump as president, but does not control the Senate. And then he can really only do things, of course, through the executive branch. We'd expect a fair amount of gridlock, certainly on these issues where the parties are pretty far apart. But there could be quite a bit of change there. The composition of the SEC would flip to being 3-2 in favor of Democrats based on Biden's appointees. And there's a lot of movement to enhance the standards of regulation best interest, perhaps really align them, the broker-dealer standards of conduct with those of registered investment advisors, and maybe elevate all of those standards. So I think you'll at least see a real effort to do that. And then, of course, the Department of Labor would be, it's an executive branch agency. And so I think you'll see probably a much stronger rule. That said, without Congress acting and amending ERISA, the department doesn't seem to have the kind of authority that they were asserting in 2016 over the IRA market. That's what the courts have said. And so without clarity there, there's limits to what they can do. Now, if there's a new president and a democratically controlled Senate and a democratically controlled House, you might see bigger changes, although I don't imagine this is going to be at the very top of the policy agenda.
So let's pivot now to talk a little bit about sustainable investing in the election. You noted in a recent column that the election will really have concrete consequences for the future of sustainable funds and sustainable strategies. What do you mean by that?
Yeah, so the Department of Labor, well, let me just preface this by saying I do think that the sort of secular momentum is towards more and more investor interest in sustainable investing, in funds that use different kinds of ESG factors in their security selection. I don't think that's going to change the investor interest, but certainly the flows, at least inside 401k plans, at least over the next couple of years, could really be determined by this election. And the reason for that is the Department of Labor has drafted a rule that would make it extremely difficult to offer what they call ESG mandate funds, and there's not a clear definition there, inside 401k plans. They would not be able to be offered as qualified default investment alternatives. That's the way most people find their way into an investment. And there'd be a really high bar for even offering them as a designated investment alternative. So, very clearly, this rule will either be, we'll just never see a finalization, or will be substantially altered in a follow-up rulemaking if Biden were to win. Otherwise, I think it's gonna blunt the momentum, at least inside 401k plans, at least for a while.
So speaking of 401ks, Joe Biden has sort of laid out a plan for them. Can you give us the gist of that?
I can try. All I can really do is give the gist because it's a very high-level plan. But what he wants to do is replace the current tax benefit, where people make the contributions prior to paying taxes, with the exception of FICA taxes, and therefore get a benefit that is based on their marginal tax rate, the highest tax rate you pay in a progressive system, right? So it's on the last dollar earned. What he wants to do is replace that with a flat credit, so everybody gets the same amount. Now, I have to say the devil's really in the details here. If that flat credit is something like 26%, which I take it from outside analysis is what would be roughly revenue neutral. I don't I think that obviously benefits lower income people whose marginal rate might be 12%, so they're getting more money for contributing than they otherwise would. It hurts people whose marginal tax rate is above that. That's not that many people. It's probably fine. The credit starts to get lower, either because they're trying to make it refundable or what have you. It might discourage employers from offering plans. We're trying to think about ways we can analyze that. It's hard to do. I mean, there's not like a good natural experiment there. The other feature of this plan that we think is part of it, although it's not that clear, is that the government tax benefit would go directly into the retirement plan. And I think this is a really good idea. It essentially makes the tax break like a government match. I think people are fairly inelastic in changing their rate of contributions. I think basically what you'd see is, 26% more or whatever that number is going into retirement savings. And ultimately that money would be taxed when it was withdrawn. So it's this is not a bad deal for the government, and it's probably not a bad deal for ordinary people. So we'll see where that goes. But I do think the devil is in that detail. That detail of how big that flat credit is, I think, really does matter in terms of incentives.
Well, Aaron, thank you so much for your time today. We appreciate it.
Thank you so much for having me.
I'm Susan Jabinski with Morningstar. Thanks for tuning in.
And lastly, Aaron Lash from Morningstar Research Services finds cheap investing opportunities in alcoholic beverage producers.
The consumer defensive space once again lagged the broader market's recovery in the third quarter through the beginning of September, chalking up a low teens % gain versus the mid-teens amassed by the broader market. Despite this more tepid performance, we continue to view the consumer defensive space as slightly overvalued, trading at a 4% premium in aggregate to our assessment of intrinsic value. This outsized valuation is particularly pronounced within the consumer packaged goods and defensive retail subsectors, which trade at high single to low double-digit % premiums relative to our fair value estimates. Despite this, we continue to see value within the alcoholic beverage arena, which trades in aggregate at nearly a 15% discount to our intrinsic valuations. Since the onset of the pandemic, the dichotomy between at-home and away-from-home food consumption has continued to persist. More specifically, at its peak in April, at-home food consumption accounted for 66% wallet share, which is far above the historic 50-50 split that has tended to characterize the space. As such, we think the onus is on consumer packaged goods manufacturers to ensure that they're continuing to invest behind innovation and marketing so as to keep these newly acquired consumer households within their foray. In addition, we think that this spend also stands to ensure that they remain entrenched partners for retailers that will be looking to continue to drive traffic to retail outlets, even as concerns surrounding the pandemic subside. Conversely, we think that the market's concerns surrounding away-from-home food consumption are overdone. More specifically, we think that as social distancing mandates are relaxed and concerns surrounding the virus begin to fade, that at-home food consumption will approach pre-pandemic levels by 2022. For investors interested in the consumer defensive space, we'd suggest no Molson Coors as quite attractive at present, trading at a 40% discount to our $55 fair value estimate. While its legacy brands have struggled to transition into higher-end growth segments of the alcoholic beverage space, we think its recent entry into hard seltzer could prove quite interesting based on initial results. In addition, we think that the margin of safety implied by the current share price suggests irreparable brand damage across its major trademarks, which we think is unwarranted. As such, we think investors should consider building a position in no Molson Coors.
That does it for this week's Investing Insights podcast from Morningstar. We hope you have enjoyed our program and we welcome your feedback. Please send your comments and questions to podcast@morningstar.com. From everyone here at Morningstar, thanks for listening. This recording is for informational purposes only and should not be considered investment advice. Opinions expressed are as of the date of recording. Such opinions are subject to change. The views and opinions of guests on this program are not necessarily those of Morningstar Inc. and its affiliates. Morningstar and its affiliates are not affiliated with this guest or his or her business affiliates unless otherwise stated. Morningstar does not guarantee the accuracy or the completeness of the data presented herein. The podcast is for informational purposes only and should not be considered tax advice. Please consult a tax and/or financial professional for advice specific to your individual circumstances. Morningstar Research Services, LLC is a subsidiary of Morningstar, Inc. and is registered with and governed by the U.S. Securities and Exchange Commission. Morningstar Research Services shall not be responsible for any trading decisions, damages, or other losses resulting from or related to the information, data analysis, or opinions or their use. Past performance is not a guarantee of future results. All investments are subject to investment risk, including possible loss of principal. Individuals should seriously consider if an investment is suitable for them by referencing their own financial position, investment objectives, and risk profile before making any investment decision.